Is that better? Is there audio now? Oh, okay, so is there audio now? Can you guys hear me now? Check, check. Yeah, you can hear me, right? I cannot believe that I didn't have my audio on. Is this better now? You guys should be able to hear me. Okay, I am so sorry. That is super embarrassing. I'm going to go back and I'm going to delete all of that out of this through editing through YouTube. But this is what I was saying, guys. Today, I'm going to give you guys a breakdown on the housing market and mortgage market. And I'm going to show you guys insider mathematical secrets about how to find a good deal. And I also wanted to remind you that I'm probably going to be purchasing a house within the next 4 months. If, right, there's a huge if it makes sense mathematically, if I can find a property that's well under market value that I can cash flow on, and you guys should know in my market here in Houston, that's exactly what's going to happen. And I also wanted you guys to know I'm going to have everything time-stamped. I said good morning to everyone, and I am sorry for embarrassing myself. Everything, again, is going to be time-stamped. You guys, I love you, and the first thing that I said when I started this is I gave Mitch the day off. I wanted to do this solo to remind you guys that I am just like you. I am a normal person who fell into this, and I'm trying desperately to give you guys back the amount of value that you give to me. You guys allow me to do this. One day I want to be an investigative cinematographer, but right now I'm going to help you guys. And oh my gosh, here's my buddy right here. Armando, I appreciate you. Me and him are going back and forth on Jack's channel at Nobody Special Finance, and it means a lot to me. It means a lot to me for the support. I really appreciate that. It's not needed, brother, but happy Tuesday. And I want you to learn a lot today, okay? So hang on, come back here, look at the timestamps. Where we're going to start, guys, is we're going to look at a quick market update. There's Pirate as well. I appreciate you, brother. I really do appreciate you. All right, let's get started with the market update. I'm going to put the timestamp. Man, I told you guys, I told Mitch I forgot how to do this. It's been so long, and I muted myself, guys. I muted myself. How do you do that? All right, let's take a market. Let's go around the market, see how the market's doing. Starting with the Dow. So the Dow's starting slightly up. It went down, I think, 300 points yesterday. But take a look at the 1 month yield. Really important thing that I've learned about the stock market, because I hate the stock market. In fact, I hate bankers. I just want a normal, peaceful, balanced, happy life. That's it. I don't want to work to my death and have nothing. So what I really learned about the stock market is it yields way better returns than pensions and 401ks. And that's caused me and allowed me to clearly understand pensions and 401ks are generally a bad idea. Now, I get company matches, right? If your company's matching, that's great. But I say it's a bad idea because the amount of money that goes towards fees and penalties, they take your profit. So pensions and 401ks, when you give them to financial advisors, they take your yields. That's why almost everything else is such a better idea, even though I'm not saying invest in the stock market. I hate the stock market. But regardless, you guys, it's up 0.5% over 1 month. So all that drama, right? You're up 0.5% if it doesn't close down. Here's the S&P 500, 1 month up 1%. So annualized, that's not bad. That's 12% over a year. Let's take a look at the S&P 500. Okay, opening up 1% almost. Okay, so it looks to rebound. Now, this is up only 0.63% over 1 month. And the S&P was booming, I think, the beginning of the, I'm sorry, not the beginning of the year, but what'd you guys say? When was it booming? Maybe fallish into winter it was booming. It's now lagging. So interesting to look at that. I've been telling you guys to what I've been doing, because I'm not a financial advisor. I've been slowly getting into silver. I have not purchased silver in the last 2 months because my purchasing power has taken a hit. During my battle to abolish property taxes, the county hit me with roughly $9,000 back tax bill, and it completely, it hurt me. It put me in a situation to where I couldn't invest in silver right now. But normally what I would do, how I invested in silver is I started with 100 ounces. I purchased at $29, and then every other week or every month, I would purchase 10 ounces at a time or 20 ounces at a time, and I would slowly get in because I'm looking at it as retirement. Okay, so gold is down today 0.5%, but look at how much is up over 1 month. So gold's up 6%, 5.96 over 1 month. But I've been investing in silver. It's still cheap. It has a long way to run still. There's inflation going on. I invested here. This thing right here is ratcheting up. It's at 58.61. I mean, it's absolutely shocking. And look at the 1 month. Look at some of these yields, man. This is crazy. So 1 month, silver, okay, 22% in 1 month. That's insane. Look at over 5 days, 14. This is a metal. This is a mindless metal that you could store with a bank. You could put it on your desk. You could do anything you want with it. It's killing the markets. All of these geniuses and algorithms and computer programs are being crushed right now from a mindless rock. That's how bad things are, right? That's how bad things are and highly leveraged, and how things are falling apart in the inflation and the robbery and the wealth transfer and the cost of living crisis. That's what you see here in these yields. Year to date, it's up 100%. Over 1 year, 89% in silver. So if you followed along with me kind of on my, and I know you did, Monica, and actually Monica purchased before that, you guys, you're probably doing really well, but we're not saying rush into the market. Take a look at crypto. Crypto meltdown continues. Bitcoin rebounding though, actually almost hitting 90,000. This got down to about 80,000. I don't think it went under 80. But here's the thing. I thought a lot about crypto because it took me the longest time to understand crypto. The premise of crypto could be good. Decentralizing peer-to-peer banking. It could be good because we don't want to make the banks rich. We want to work with one another in society. But the problem is, it's no longer like that. Even our government, the US government, has first of all, they've created their own stable coin, but they purchased massive amounts of Bitcoin. They ruined it for us all. And so because of that, and again, I don't know enough to really talk about this, but in my mind, that's how I'm looking at it. It could have been great, but like all great things, it's completely ruined by money or the government. And that's what I see here. Comment below. Maybe you think of it differently. I just don't know enough about crypto, but I could tell you XRP is also down. It's up today about 3.84%, but it's down 16.1% over a month. So I'm not ready to invest in crypto, but I am ready to decentralize, and I chose metal over crypto. So that's basically what I did. So I'm choosing metal over crypto because I don't understand crypto and the government's playing around with crypto. So I'm sticking with metal. It's biblical and it's working out great for me. And that's where I put my down payment. And now my down payment is almost double. And that's, if I lose my down payment, I'm dead in the water. And I wanted to remind you guys, I can't make a bad decision when purchasing my house. Okay. I have to if I make the wrong decision purchasing my house, I'm not set up to make wrong decisions. We have a whole bunch of kids here. If I make a wrong decision, I go bankrupt. Okay. So I'm nervous. All right. I'm nervous. And that's why it's taking me so long, because I want a great deal. I don't think anyone can blame me for that. But look at this, guys. Okay. If you're wondering like what's going on, the inflation, like how come things haven't crashed? Well, they have crashed. They just keep getting propped up by money from the government or the Fed. The national deficit just came out, and this is atrocious. Okay. I was hoping to see a negative number here because of the tariffs, right? The top line number. But that's not what we saw, okay? Instead of a negative number here, we saw one of the worst starts to a fiscal year in the history of the United States from a numeric amount, okay? So if we include inflation, maybe it changes. But right now we're at $284 billion deficit in just 1 month. I want you guys to understand, if we, this is how bad this number is. This is a really, really bad number you guys see here. If we annualize this, so if we multiply that by 12, that's around, I wrote down, $3.412 trillion in deficit. $3.412 trillion. If we scroll down to look at the deficits, the yearly deficits, look at this. Okay, let me show you guys. It would be the worst. The worst was right here. Okay, this was right here, 2020. We had a $3.13 trillion deficit. That was lockdowns. That was the PPP, EIDL, all of that type of stuff. I'm letting you guys know we are on pace to exceed that. Call it what you want, but that's mathematically what it looks like. To me, absolutely terrifying. Absolutely terrifying, because it's going to make it to where the cost of living crisis only gets worse and the wealth transfer accelerates. This is going to crush mom and pop if they keep doing this. It's absolutely atrocious, guys. So just be aware of that. And also look at this. Let's go and look at a little bit of the inflation. Here's the reverse repo market. So the overnight reverse repo market. I'm showing you guys this because this is basically sputtering. So right now there's $3.2 billion of, let's just say, excess liquidity slushing around in this account in the markets. It's drying up. We know it's drying up because look at this, guys. When we look at just the repo, not the reverse repo, when we look at just the repo, there's quantitative easing going on right now. There's essentially an injection overnight of $13.5 billion. That is the second highest in years. Look at this, 13.5. So I'm wondering who's got turmoil right now. What bank is in distress? Pretty much all of them, right? Except maybe the big 7 that are sloshing money around back and forth. But this is showing you and showing all of us right now that some bank, we don't know exactly which one, is in distress. And honestly, it's probably has something to do with corporate bonds, private equity, private credit, something like that. But nevertheless, it's happening, and you see it here. There's $13.5 billion yesterday that was injected into this account. Okay, so bad things are happening. Now take a look at this. This is a 5-year break-even inflation rate. What this shows you is how useless the Federal Reserve is. We just got out of 3.5 years of quantitative tightening, and they've done nothing for inflation except keep it elevated. All they did is they tried to make it to where we accept 2% inflation. But the thing is it's a joke because they never hit 2% inflation. They never did. I want to remind you guys, going into the pandemic, okay, inflation was anywhere from 1% to 2%. So low 2s to low 1s. You see that? So why do we have to accept inflation up here? Why don't we just say we don't want a Federal Reserve and we want the banks to go bankrupt because they're making horrible decisions? Why, as taxpayers, are we paying this? The reason why, and this is why they sell us, and this is the trap, you guys, we got to do a bailout because your 401ks are down 40%. When the reality is they were never real to begin with, and if you would have just bought metal, you would have been fine. They sucked you in, put the claws in, and now you're stuck in the system if you are leaning on your 401k. It's messed up, but that's how this works, right? Let's keep going. I'm going to show you guys this right here. M1, this is the injection of money. You see this? So M1, horrible injection of money. They do quantitative tightening, consumers hurt, and then they just take a break and money supply starts going up again. So again, I'm showing you these things because I want you guys to always remember how useless the Federal Reserve is exactly, and how the Federal Reserve is not for mom and pop. It is for the bankers, and it's absolutely horrible. So we're going to go to our first video. Okay, we're going to go to our first video now, and after this video, we're going to get into the really good stuff, which is our mortgage update. I'm going to teach you guys how to look at a mortgage amortization schedule, and then we're going to go into the real estate update, and I'm going to show you guys how to find a great deal. But first, let's listen to this video. This is a former vice chair of the Fed talking about how inflation affects blue states and red states differently. Now, the reason I want to play this video for you guys is as you're listening to this shill, I want you to ask yourself, are these really the people that are leading us? Do these people really understand what's going on here? And I want you guys to remember what politics really are. Politics are really just a mechanism to divide you and I from working together. Politics is all an illusion. If someone asks me, what is my political affiliation? I'm going to tell you right now, it's mom and pop. I don't care about Republicans or Democrats. They all scare me. They're all lying. They both take away our rights. I care about you and me and our families. And quite frankly, you guys, listening to this next video, when I was listening to this, I'm like, we're so cooked. We're so cooked. I don't know what to do except keep fighting and keep telling the truth and keep trying to lead a charge to make changes. So if you guys can, let me know that the audio is okay, and we're going to get started with our first video.
This former Fed Vice Chair Roger Ferguson. He is the former president and CEO of TIAA, and now Vice Chair of the Business Council and a CNBC contributor. Lots of titles, Roger, because there's lots of wisdom there. That's why.
You're absolutely right, Steve.
I want to get to the about face the market did with what happened last week. I was reporting one hawkish Fed president after another. The market was going down in terms of the probabilities. And then John Williams said 2 words, near term, and everything turned around. Was this the right call by the market, you think? Do you think John is out there? I call it the intellectual pulling guard for the chair.
Look, that's certainly the way the market perceived it. To be fair, I share some of your concern that one speech suddenly changes the outlook and the view that the markets have. No doubt that John personally is very close to Chair Powell. More importantly, the role as vice chairman of the FOMC, which sits with the New York Fed, comes into play here. But I think the market is reflecting what it heard, and we'll see if that's the right call. I actually think it puts the Fed in sort of a tough bind now, because there are many folks who I think are not ready to make the move. But on the other hand, now the Fed risks, if you want to use that phrase, disappointing the market. So, I think it's become a bit more of a conundrum than one would have liked.
Right. So they took away the flexibility. But Roger, I was sort of on board with some of these folks who were saying, hey, 4.5 years going on 5 years of being above target. The economy doesn't look that bad. It's time to start to address the inflation issue. But then they seem to be backing off of this. Where would you stand in this question?
I'm very much with you. Inflation has been running not just somewhat above target, but call it 2.9, maybe 3%. It doesn't round down to 2. A lot of the factors that have been driving that you've been talking about, some of them may ease. Housing may ease over time, but that's a serious structural problem. I think the argument for the labor market being dramatically weak so as to needing monetary policy assistance to me is not that strong. So I'm very much with you and with those who would be much more cautious about this December move.
There's a hear no evil, see no evil aspect to this, Roger, in the sense that we have a lot of private sector data on the job market, and we can sort of see that data getting weaker. We don't have good data when it comes to inflation in terms of what's happening out there. And so I think the feeling was, I'm watching this jobs data get weaker. And as far as I know, the inflation data is okay. Do you think that they're siding on the right risk here?
I do not. I hate to be so overly critical of friends and former colleagues, but my view is the risk here on the inflation side, and most importantly, on maintaining short-term credibility around inflation, should not be ignored. I think there's a whisper in the market that maybe the actual inflation target is somewhere around 2.5, maybe 3. I don't think that's what they want in the marketplace. So if I were a voting member, which I am not and have not been for a period of time, I would be in the hold camp for now. And if I can say one more thing, President Goolsbee from Chicago some time ago said something I found very insightful, as he often does, which is, in the absence of knowing what the inflation data are, it's a lot harder to get that genie back in the bottle. And so maybe you err on caution because you don't have information giving confirmation about inflation coming down.
All right. Well, Roger, real quick, would you delay the meeting for the data?
No, I would not. Becky,
I think you're wrong.
You're wrong.
You may think I'm wrong.
Go ahead.
No, I know you think I'm wrong. That's fine.
Answer the question. Sorry.
Look, I've been thinking about this a bit since you posed the question a little while ago. My initial answer, I think, is still true, which is you don't want to be in a place where you seem to be whipsawed by, let's wait for the next piece of data. If you start doing that, then you're going to open up a whole new question, which is, should we keep to the original meeting schedule? And, you can have a debate almost every meeting that some new piece of information is going to come in.
Houston's holiday tradition, a Christmas.
So let me know what you guys thought of that. We're going to go into the mortgage. Ooh, the 10 years up a little bit. So what you guys thought about that? When I was listening to that and him talk about whipsaw data, we don't know what the market wants. Like, we don't, just stop. Just stop, right? Just stop printing money and spending money that you don't have. That's it. That's how we can end inflation right now. Just stop what you're doing, right? You guys, they're debasing the dollar. They're weakening our purchasing power. Again, that's why metals are going up so much. So if you think that they're debasing the dollar and that the dollar is being destroyed right now, then probably the concept is, I'm not a financial advisor, but the concept is metals. It's biblical. There's a reason why it's biblical, and there's a reason why we have the 16th Amendment to the U.S. Constitution that forbids the government from taxing us on our properties. Think about, I have a video coming out today that I made with Mitch. It's so good. We're starting to really dig in on how abolishing property taxes can help first-time homeowners, the poor, renters, farmers. Think about the farmers, all of the crisis we have with farmers. Imagine if they didn't have to pay property taxes. Then they don't go bankrupt if China's not going to buy their soybeans and stuff of that nature. So right now what we're working on is coming up with the rebuttals on how eliminating property taxes is really literally going to help us all. And it should have never come to this point. We should have never been taxed on our properties. Again, it's in the Constitution. People died for that. People died for those rights, and we just gave them up. Maybe not you and I necessarily, but it's been given up, and it's a horrible thing. So let's go into the mortgage update now. I'm going to put that at 21. I'm going to teach you guys some really cool stuff here on mortgages. So let's pull this first thing up. I'm going to show you guys real quick. Let me switch my cameras. So here's the 10-year treasury. Now this tracks residential mortgage rates, but the yield has been slipping because this used to have to go under 4% for us to hit FHA mortgage rates under 6. So that had to be under 4 for us to hit under 6. But now that's no longer the case because it's been a greater spread. Basically, the spread is narrowing for the banks. So 4.1 right here, 10-year treasury, but look at residential mortgage rates. This is crazy. And I want to remind you guys of a couple important things. And if you have to rewatch this, just come to this timestamp and rewatch it, because I'm going to give you guys a few terms here that you may not know, but it's important to understand. So here's all of the various loans interest rates. I want to start with the top column. Okay, the two that I've highlighted. I highlighted a 30-year conventional mortgage, and I highlighted a 30-year jumbo mortgage. You guys can tell that the conventional has a 6.1 and the jumbo has a 6.4. I wanted to remind you guys the reason that is remember something called LLPA. Okay, that's a risk-based pricing model that the lenders use. So LLPA, the higher the risk, the higher your cost, the higher the interest rate. And that's why you see that 6.31 go to 6.4, because there's a built-in penalty, because it's a jumbo loan. And because you're financing a jumbo loan, it's a higher risk for the banks. Remember, that's called LLPAs. And that's why if you have great credit, you don't have as high as an LLPA. So remember, anything bad like credit, income, down payment, whatever it is, LLPA hit, LLPA hit, LLPA hit. Now, also look at the bottom middle right here. That's a 30-year fixed FHA mortgage. You're going to see clearly that it's close to a half a point lower or 0.5% lower than conventional. So you got to really weigh this out, okay? And I'm going to just break it down to what is the biggest difference between FHA and conventional. So the good things about FHA: lower interest rate, lower down payment. It's easier to qualify for, but the disadvantage could be summed up as one thing: mortgage insurance premium, or MIP, or upfront mortgage. Conventional has PMI, which is same thing. It's private mortgage insurance. But with conventional, your mortgage insurance will eventually go away if you hit 22% of equity, or if you hit 20% of equity and you write into your lender to request the PMI be removed. So that's it. That's the only advantage of conventional. So if you're going to get if you qualify for a conventional and an FHA and your credit is about 680 and you're only going to do a minimum down payment like 5% down, odds are, I'm not a financial advisor, but I've been doing this for 2 decades. Odds are FHA is better. Usually it's, when you really look at it, conventional is not going to be better unless you have excellent credit, and I would say over 5% down. That's the odds. It's just your individual situation is different. And also, don't forget this, you guys. I can personally, because I shop my mortgage, when I run my credit report, there's a grace period of about 30 days. So I'm shopping my mortgage. I know where to go. For me, and probably the same thing for you, I have excellent credit. So I can get a half a point roughly off of everything you see here. And so should you, okay? If you're doing what I'm saying. Great credit, shop your mortgage, understand that you got to pay this thing back for pretty much your whole life, right? Unless you're doing something about it. Which brings me to the next thing. Debt can be a good thing, okay? Again, debt can be a good thing if you know how to use it, but most people unfortunately don't know how to use it, and it ends up being a bad thing, and they end up being a servant to their debt, okay? It is what it is. So you got to understand how this debt works. So the first thing I want to do to show you guys is I'm going to show you guys the interest on a 15-year, a 30-year, and a 50-year, because there's been a lot of talk about 50-year mortgages. So here's the interest right here. Okay. This is the loan term, 15 years. This is today's interest rates for conventional. This is only a loan amount of $200,000. Okay. So on a 15-year mortgage, your interest is $109,000 over 15 years. So 15 years, it's 109,000. But look at what happens when we go to 30 years. So it goes from 109,000 to 246,000. So it jumps up big time. But look at what happens when you do a 50-year mortgage. So a 50-year mortgage, it goes from 246,000, which exceeds your loan amount. And if we put a 50-year, let's see what happens. Look at that. Insane. Insane. It goes to 459,000. That is 259% interest or something. 259% interest if you get a 50. So don't get a 50 years. So let's go back to a 30-year. Okay. Back to a 30-year, 246. Now, say you can't afford a 15-year mortgage right now, or you didn't qualify it, or you don't want to be locked into a higher payment, that's fine. Or if you just want to, like, if you're debating refinancing because you don't want to stay into debt, maybe you should look at an amortization schedule and start talking about putting extra money towards principal to get out from underneath this debt. Look at the power. The power of paying extra money towards principal cannot be understated. If I pay $250 extra per month on my mortgage, let's calculate how much time I would save. So that's crazy. Okay, so that's crazy. Dang. So if it's a higher loan amount, you're not going to have, I mean, that's a huge, right? So if I pay $250 a month, okay, I'm saving in just interest about $100,000, and I'm saving about 10 and a half years. 10 and a half years. Think about it. 98,000. And here's the best thing about that $250. It's my money. All I'm doing is paying down the loan. If I sold my house and the value stayed the same and there wasn't a bunch of fees, I would get the $250 back. So I'm paying myself, understand what I'm saying. I'm paying myself to save money. Okay. The banks don't want you to know that. The banks want you to stay trapped and drowning in debt. But all you guys, again, you don't have to refinance. You don't have to do all those things. As long as you can afford it, and you should really, really try here, you should just put a little bit more towards your principal, get out from underneath that debt, and start living a debt-free life. Unfortunately, we still got to worry about property taxes, but one of the best things people could do right now for themselves is get out from underneath their mortgage. So hope you guys learned from that. That is so important. As I would say, the two most important things about real estate, number one is how an amortization schedule works, and number two is how to do a local analysis, which is what we'll be doing next. But I'm going to shift to our next video right now, which is a Redfin video. So we're going to listen to a Redfin video about the housing market, about how people are delisting their homes so fast, and that's creating a floor under prices. Well, there's a lot of floors under prices, and that's why it's so important to use raw data. I'm going to tell you guys, using macro data to do local real estate analysis, it doesn't work. If I gave any of these data providers, any of them, Zillow, any of these people, one address, their software cannot calculate wedge and cash flow. They can't calculate. They're useless, you guys. That's why you got to do what I'm showing you. You take raw data and you figure out the true advantages. If you're just using these data companies, they're not going to tell you anything. Okay, they're just going to say, nah, this is why this is happening. This is why. It's never going to be the truth. Remember, they're lobbyists. Okay, remember realtors, didn't they get, and I'm a realtor, I can say this, they got popped with conspiracy charges. People forget that this is a crooked system. Literally, just stop and look at any one aspect of what's going on. It's all fraud. It's all greed. It's all corruption. And that's why, for me, it's all about you and I. And that's what matters to me. So let's go into this video. And if you can, let me know that the audio is okay. Let me tee this up right here. And I hope you guys enjoy. And then we're going to get on to our market analysis. And I'm going to show you guys how to find a great deal on real estate.
Mortgage applications jumping to a 2-year high just this last week as interest rates held largely steady. But at the same time, sellers are pulling the homes off the market at the fastest pace in nearly a decade. So what's going on in housing right now? Joining me now to make sense of all of it is Redfin CEO Glenn Kelman. This is a ridiculously interesting story right now, because if you didn't really know what those metrics were, you would have no real idea that people are just not happy about keeping their house on the market for that long. What exactly is driving the staleness in the housing market right now?
Well, we've just had a massive shift from a seller's market to a buyer's market, the first shift in at least a decade. And everyone is just taking a moment to adjust. There are some sellers who can't sell and pay off their mortgage. That also is something we haven't heard in 10 or 15 years. And so the whole market is going through a massive transition.
The transition that's happening right now, do you have any kind of visibility on how long that transition lasts? When can we expect maybe, I guess it's all relative, but quote unquote normal behavior for, say, a spring selling season?
Well, I think it will come in the spring when the market changes over the winter. Many people decide just to pack it in, celebrate at home, put up the tree, and then try again in January, February, or March. So around the time of the Super Bowl, we'll see what direction the housing market is going to take. But until then, I think we're going to be in a limbo. There's macro uncertainty just around the whole economy. We've seen some high-end demand take a hit just because the stock market has been volatile. So people have really been worried. And when people get worried, they sometimes don't take that 30-year bet on a new home.
No, of course they would not. It makes perfect sense. I guess at this point, Glenn, what exactly would you need to see in the coming months that would get you saying that maybe buyers and sellers can get more comfortable? It's easy to say interest rates have to be lower, but it maybe isn't that simple.
Well, lower interest rates will always help, especially if rates drop below 6, which is always possible. But I think the other factor is just home prices. So we have had a correction without a correction where sales volume is down as much as 50% in some markets, but prices are about the same. And so sellers are looking for some kind of indication that they aren't going to be able to get the price that they want. That is the only reason that they will invest more in repairs or drop the list price. And meanwhile, buyers think that time is on their side, that if we wait until the spring, these buyers will get a better deal. So that's why there's a standoff right now. If there's no change in home prices, but the economy remains uncertain, I think we're going to see low sales volume because sellers are going to hope for the best and buyers are going to wait for a better deal.
Glenn, you've also got a very interesting bird's eye view. The data that you collect across home listings gives you a unique view into what's happening with individual pockets of the housing market. So where exactly are the cold spots right now? Where are people pulling the most listings? And where exactly are we still seeing a lot more activity on that relative basis, geographically speaking?
The cold spots are the hot spots. So in places like Florida, where the weather is nice and people were moving like crazy during the pandemic, we now see that more than 70% of listings are stale. Where there has been the sharpest increase has been in the Washington, D.C. area, probably because of DOGE and uncertainty over federal jobs. Many people there are trying to figure out what to do because they can't sell their house and they can't lower the price. If they lower the price, they're not going to be able to pay back the mortgage. So couple of spots where people are really in a jam, but I'd say Texas and Florida are where we saw the biggest run up, and now we see the most stale listings.
Yes, sir. That is correct. And why is that, you guys? I want you to comment below based on what I've been covering. Why would you say that there's issues in Texas and Florida the most as opposed to any other state? Why would you guys say that? Why do you think? Any comments on the bottom? I've been covering this a lot. Any guesses? Anyone guesses what I'm thinking? I will put it up on the screen. But you guys, I mean, you guys should have been, hopefully you've been following me. I know we've been at this for about 3 years, but you guys should be better off. How come Texas and Florida have lower prices on houses or house value? Exactly. There's Nikki. Is that you, Nikki? Is that the original Nikki? New builds. Also hurricanes. Yeah, and hurricanes and insurance. Okay, hurricanes and insurance are bad, but new builds, we have so many new builds. Around my house, there's probably 10, 15 brand new build communities. We have so much inventory here. I would say, depending on the market, over half in Houston, in the surrounding area in Houston, over half of our inventory is new homes. We have so much, we're popping out of the seams, so much new homes, and they're doing 2% interest rates. 2% interest rates in Houston. So the new home market is very, very much so bifurcated than existing homes. It's very, very crazy. So here's the thing. Okay, this is good. This is my favorite part of doing our live videos. Now, I want to remind you guys, anytime from now on that I do a wedge analysis and a cash flow analysis live in the market, I'm going to then upload it onto my website under the market analysis class. So you guys can access multiple breakdowns of how to use raw data, because remember exactly what I'm saying here. When it comes to raw data, there's no financial bias. There's no financial bias. Raw data is king. You cannot use these macro data providers because they don't do anything for you except try to manipulate the way you're thinking. Just give me the math and let me do some simple division, simple multiplication, subtraction, and we're going to figure out what the market looks like. Okay, so we're going to do that right now, but don't be paying for anyways. I got to be careful what I say. So here's a couple things that I wanted to remind you guys real quick. Okay, let me switch to my other camera right here. So here's what I need you guys to do. Anytime you want to look at a property, especially if you're not in a state in Texas, or if you're an agent, this is exactly how you help your client. This is exactly what good professionals in my area do to help their clients. Now, here's my website. I want you guys to come here, and please note on the top, I've recategorized the tabs. Okay. Hopefully I'll have this video done today. I'm doing a few things. I know they banned me from TikTok. I got banned from TikTok for impersonating myself. I don't know how that works. So all my social media is here. Please go to my social medias, start a conversation with us, but you're going to go to the home buying tab up here. So you click the home buying tab right here, and I have courses for you guys how to do a market analysis. So in this course, how to do a market analysis, I will be uploading this next segment so you guys can always go and watch that. Now I'm going to download this form right here called your subdivision analysis form, which is completely free. Here's the form right here. So I'm going to fill this out. Now the most important thing is to get the market home value per square foot and the market rent per square foot. That's it. That's all you need to like figure out a whole bunch of stuff. Now it's gross wedge, right? This is a gross way to do it. You still have to do other due diligence. Okay. So you take this form, then you go into the MLS, which is right here. Let me go back. I looked at a little bit. So let me show you first of all what we're dealing with. Okay. So here's the problem, guys. I have 100,000 listings. Okay. So I got to crunch 100,000. Let me show you the map. All right. So I'm working with 100,000 listings. It's too much noise. I don't want to look at overvalued houses. I only want to look at like a house that is a decent deal. And look at it. There's so many listings. It's not even reporting them all. Look at all these listings. Okay. So let's go in the market. I'm going to show you guys. So here's, holy smokes. Look at how many listings are in Kingwood. Look at this. Okay. So this is in Kingwood right now. Way too many listings. Look at these new houses. That's new houses. See, they're clustered up 9 and 4. Let me show you guys, Colony Ridge real quick. That's over here. You see this? This is like a foreclosure epidemic. It's like 50% foreclosures. This is all the illegal immigration hotspot right here. There's all kinds of corruption and fraud. This is very close. Plum Grove. Okay. I've done 4 videos. People are like, go out there and check it out. I'm like, I've already done 4 videos. No one watches the videos. No one likes those videos. So and it's really depressing going out there for obvious reasons. So anyways, guys, there's way too much data here. So what I have to do is I have to first filter the data. I have to take 100,000 listings and eliminate the noise. Okay. Because I've decided that I want to find a deal of a lifetime. So I'm going to narrow the data down by, not by purchase price. Okay. I'm going by price per square foot, which takes purchase price and size. So you're taking 2 different inputs and you're coming up with something. So I'm going price per square foot. Okay. $80 to $100. So it takes 100,000 listings and it turns it into 1,940. Okay. So that's less than 2%. So I would say in my market, about 2%, a little less, depending on, a few things, roughly about 2% of listings are well under market value. This is crash. It should be crash like what? We'll figure it out now. It should be crash like reg. So now that I've filtered that, I then go in and I look for a property that I want to do an analysis on. So let's go back to where I was just at, Kingwood. Now look at Kingwood. So remember when I showed you guys Kingwood, there was listings everywhere, right? Everywhere there was listings, but now I eliminate all of that noise. And now look at, I have 1, 2, 3, 4 listings. So instead of like what? Close to 200, I have 3, 4 listings. Do you see how much easier this becomes? So I'm going to click on this property right here. Okay. And I'm going to show you guys what you need to gather. So there's only a few things you need to really do an analysis. And it's very, very quick, guys. I need the purchase price, which is $249,000. Okay. I need the subdivision because remember, and this is why I can smoke these data providers. Data providers are useless. You have to do a local analysis on the market, which is the subdivision. A subdivision is a local market. So you have to look at the subdivision. If they can't break down subdivisions, do not pay money for their data unless you like them. Okay. So subdivision, size of the house, and purchase price. And then I go to the tax tab right here. And then I want to know how much the taxes are. First of all, this is overassessed. It's for sale for $249 and it's assessed for $266. Again, showing you guys that we have overvaluation fraud happening in Texas right now. I wish someone would, like that could do something, would reach out to us. They just want the scam to keep on going. But regardless, I'm going to make a note of the taxes, which is $6,222. Okay. So I'm going to go back here now. I'm going to do a search of that subdivision, but first I'm going to go back to my form and I'm going to write down all of the things that I just highlighted. So here's the subdivision, Elm Grove Village. Here's the address, hypothetically, 12 Main Street. Here's the purchase price, $249. Here's the size. Here's the taxes. Okay. So now I have to figure out what this is and what this is. So I have to do market price per square foot and rent price per square foot for this subdivision because why? Real estate's about hyper local analysis. Don't let these people bully you. Don't let these realtors bully you. Just use the raw data. Stay away from their emotions. If they're belittling people, stay away from them. You do not need them. You do not need, just my opinion, you do not need them unless they're fantastic. So now I have to do an analysis again on Elm Grove Village. I have to find these two things out. So I go back to my data. And in certain markets, you could do this on Zillow, but I lock it down to Elm Grove Village. You see that? And I want sold properties over the last year. If I was purchasing this myself, I would do a 4-year history. Okay, so we're going to go 365. Okay, let me make sure everything else is good. So I have 57. I'm going to look at results. Okay, now here's all of the properties that sold in that subdivision over the last year. So here's my market right here. Now, but that's not all you have to do. You also have to only look at comps within a certain, you should, right, depending on how many comps there are, within a certain size variance of our subject property. Okay, so size variance means, like, for example, our subject property is 2,700 square feet, but this comp, which is a sold home, is 1,300 square feet. So it's half the size. I don't want that comp. That's a horrible comp. I want comps that are about 10% to 15% variance, or in my market, about 500 square feet difference. So if it's 2,700, I only want to select houses that are 2,200 to 3,200. Okay, so I'm going to look, and I've categorized this by square footage. Okay, so this is it here. So I only have 7 comps. Dang, that's crazy. Okay, so I only have 7 comps. And that's honestly, that's the most realistic way to do this. Okay, so I'm going to hit stats. I'm going to add all this essentially together. And then I'm going to divide by 7. But this is automatically going to create this for me. Okay, which gives me a price per square foot, which is pretty low. I'm pretty surprised how low that is $105 right there and 80 cents. Okay, so I'm going to go back to this form. I'm going to put 105.80. That's really low. Surprised. Okay. Now we got to do rent per square foot. Okay. So we got to go back into our system, and I'm going to go into the rental market right here instead of the for sale market. And I'm going to do the exact same thing. I'm going to lock it down to the subdivision because the subdivision is the local market. I'm going to do sold properties or rented properties, right, over the last year, 365. Okay. Boom, boom, boom. Okay, how many does that give us? 53. This is a pretty popular subdivision. Okay, let's look at the results. Okay, I'm going to categorize this by size because I only want, again, remember the variance, guys. Remember that variance I was telling you about. Okay, where does it start here? Okay, so I'm going to select this because it's 2,200 square feet. Let's go to the next page. And I'm going to select these 3 comps right here. So the subject property is the biggest property in the subdivision. And that's usually, you don't want that. You want something in the middle, not the biggest. But let's look at stats. Let's go to tabular. This is also very low. Okay, 94 cents a square foot. See that? So I'm going to go back here to this form. I'm going to put 0.94 a square foot. Okay, so far, so good. Now, I want to do one more thing. In order to figure out cash flow, I have to figure out an estimated payment. Again, come back here. I'm giving you guys so much gold right now. I know it's going to take you a little bit to get this. I've been doing this over 20 years. It's very easy, but I already set this up, okay? So here's the property. I'm doing an estimated payment. Contact your mortgage lender. You're not going to probably do this correctly, okay? Contact your mortgage lender to get a payment. Contact your mortgage lender. But, there's a but. If you just want to get a quick idea, this is one way I do it, okay? $249,000 home on FHA. I just did FHA, easiest loan to get. 3.5% down. Probably a bad idea to do that, but whatever. 30-year mortgage, only 5.9% interest rate. Here's our property taxes we already calculated. Now I'm using 1% for insurance, which would be $2,490 because here in Texas, we got high insurance. We got bad insurance. So I'm going 1%. Okay, and for PMI, I'm sorry, it's MIP, but it's labeled PMI, is 0.55% for FHA. And then HOA is not included in monthly. So I calculate this, and here's my total out of pocket, $2,261. Okay, so now that I have that, I go back to the form and I put $2,216. And now I can officially find the wedge and cash flow. Now remember, this is gross. These are gross numbers. I still have to get the net, which would be figuring out how much money it would cost to repair the property or to manage the property if I was going to rent it out, okay? But the first thing is, this is very easy. All we got to do is take the size of the house, which is 2,716. Okay, we're going to do the first one here, which is gross wedge. So we take the size by the market price per square foot. This is why this is so easy. Don't get emotional. Don't get emotional. So we multiply that by the market price per square foot of 105.80 gives us 287. Okay, but we reduce the sales price now to calculate the wedge. First of all, I'm going to buy that house for like, if I buy the house, I'll buy a house for like 220, but we're just doing, just doing an analysis here. So I'm going to reduce the purchase price now. We're going to calculate our wedge, gross wedge, which is $38,352. So $38,352. Okay, right there. Boom. That's our gross wedge. So we're a little bit under market value. Now let's see how much under market value we are in. Okay, so let me take the 287, 352. Was that the, yeah, that was it. Okay, so actually let me take the wedge, 352 divided by the market price, not the sales price, the market. Okay, so we got about 13.3% of wedge. So right away, even though it's under market value, but for me, it's not enough. I'm not purchasing a house unless it's like 30 to 40. Probably I would settle around 35%. So I got to have big time wedge. 13.3%, it's not good enough. Now let's do our cash flow to see if we can cash flow, okay? So just like the wedge, we're going to multiply the size of the house right here by the market price per square foot right here. See how easy this is? 2,716 times the price per square foot, which is 0.94, gives me 2,553. But remember, I have to reduce my mortgage payment that we calculated on this video. So let's reduce that by our mortgage payment of $2,216. Gives us gross, that's actually okay, gross cash flow, I'm impressed, of $337. That's okay, that's something, right? So it's a little bit, it's not enough for me, but it is a little bit. And also, if you wanted to get this down, so if you get your mortgage payment down, your cash flow should go up. If you want to get that down, some of the things you could do is increase your down payment, try to get a lower interest rate, try to get lower insurance. You're going to fight your property taxes. There's ways to get this down. But either way, you guys, that's the simple math on how to find a great deal mathematically, not having to listen to a realtor. Okay, so we're going to go into our last video. I hope you guys like that. Will you comment below and let me know if you like that? Remember, I'm going to upload that into the lesson so you can come back and you can review that anytime you want. Go to our website. You guys know how hard I'm working on this advocacy. I'm trying so hard. The system wants to eat me alive. The system wants me to give up, and the system wants me to go bankrupt. Okay, because I'm telling the truth and I'm trying to help people. I'm getting so annihilated, you guys. I've been trying so hard to maintain my purchasing power, but I'm getting beat up, and I'm going to be the first person to admit it. So I'm still going to fight. I will go bankrupt trying to help mom and pop because that's my purpose. That's what I see. So anyways, go to the website. I need to know you guys are learning. Please go to the website. Let's listen to our video. Let me tee it up right now. I love you guys. Okay, here's our video on jobless claims. Pretty interesting. So we're going to play this and then we're going to finish this sucker out. Appreciate you guys. Let me know the audio is okay.
I do, though, have some good news on the macroeconomic front. Yes, we're catching up with all the data, but the most sort of real time that we're getting is jobless claims, which is the amount of jobless unemployment claims that Americans file from last week. And actually, we had good news there, which was it was lower than expected and actually matched the lowest level since February. 216,000 jobless claims filed in the week of November 22nd. Better than the 225 expected. So 4-week moving averages ticks down if you want to smooth it over. So it continues to be the low hiring, low firing economic environment. And yes, there's been a lot of angst around the labor market lately with some of the alternative data, the ADP data that we've been tracking sort of on weekly job losses. But jobless claims, as filed by the states of Americans filing for those benefits, continues to paint a picture of lack of layoffs. And that's it just continues with this mixed picture that we are getting on the economy. Some good signs, some not so good.
Some good signs, some not so good signs. So some good signs I see are people that are fighting for the people. Those are good signs, but the bad signs are everywhere. And the people that's, what is it? I don't even know. It's CNBC. I mean, they don't know anything about us. I think the people on the news media are multimillionaires that have no recollection of where they came from, or they just completely forgot their roots. But I got to tell you guys, I'm not going to be that person. I'm not going to be the guy that's going to grift you. I'm going to be the guy that is going to go down, hopefully as a fighter for the people. And I want to go down as the person that's walking away from money in order to help you. I want to prove to you guys that I am who I am, and who I am is someone that wants to help you and ask for nothing in return except for you to pass the message and help someone else. And that's what I wanted to say today. And I'm glad to be here with you. I have a really good video coming out this evening. We're going to be back here on Friday. Mitch is going to come back. I was like, Mitch, I got to do this solo. I got to look at the people, and I got to tell you guys, I'm just like you. I am no better than anyone else. I'm a normal person. And if I could do it, you can do it. And I need you guys to do it with me. Okay. I love you more than you can comprehend. Okay. So thank you guys for joining me. Other than that, guys, hang in there. It's hard times. Fix your mindset. And when I say fix your mindset, love some people, love your family. Do not walk away from people in need. Stop yourself and go help someone. I got to tell you guys, that's what we need more in the world. Thank you for joining me. Look out for that evening video and email us. There's Charles. Appreciate you guys. I missed you. I'm going to do a lot more lives. Other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.